Slippage is the silent edge killer. It's the difference between the price you intended to trade at and the price you actually got. For long-term investors, it's a rounding error. For active traders, it can equal or exceed the entire annual P&L. A market order in a fast-moving stock can slip 5, 10, 20 cents. 5 cents per side times 500 trades a year times 100 shares equals $5,000 of pure cost on a single account. And almost no one measures it, they just look at the ticket fill price and move on. Today, where slippage hides, the order type choices that minimize it, and the tracking framework that surfaces the cost before it eats your edge. Here are the 4 sources. 1. Market orders. By definition, a market order accepts whatever the next available price is. In a calm market, it's the bid or ask. In a fast market, it can be cents or dollars away. 2. Fast moves. When price is moving aggressively, the spread widens and fills land deeper into the unfavorable side. 3. Illiquid names. Small share counts can sweep multiple price levels, especially in low-volume stocks. 4. The trade-off limit orders eliminate slippage entirely but introduce misrisk. The price moves past your limit before you fill. Each source is measurable, and the order type choice depends on which problem dominates. Watch this in a synthetic breakout chart. A trader sees the breakout fire, panics about missing the move, and submits a market order. Intended price, 100 even. Actual fill, $100.18, 18 cents of slippage in a single fill. Across the trade's exit, it happens again. Intended 115, filled 114.80. Round-trip slippage, 38 cents per share. On a 100-share trade, $38 of pure cost. The trader's chart edge made $50, slippage took 38. Net result, $12 of actual edge. The math the spreadsheet showed was 3 times larger than reality. Here's the rule that's the opposite of most retail intuition. In liquid stocks with tight spreads, use limit orders. The spread is narrow, you can place a limit at or 1 tick inside the spread and fill quickly with 0 slippage. In illiquid stocks or fast-moving conditions, the choice gets harder. Market orders give certain fills with bigger slippage. Limit orders give cheaper fills with misrisk. Pros pick based on conviction. If the setup is A grade and you need the fill, pay the slippage with a market order. If it's B grade or you have other names, use a limit and accept the occasional miss. The cost has to enter the decision. Now the correct execution. Same breakout, same chart, but the stock is liquid with a 1 cent spread. Trader places a limit order at the bid or 1 tick inside. Within seconds, the order fills at the intended price, 1 penny of theoretical slippage instead of 18 cents. Same on the exit. Round trip, 2 cents of slippage per share. On 100 shares, $2 of cost versus 38 in the market order version. Same trade, same setup. The order type choice preserved $36 of the chart's edge. Annualized across 500 trades, that's $18,000 of preserved edge from a single execution rule. In practice, add a slippage column to your trade journal. Log the price you intended to trade at, usually the trigger candle's price, and the price you actually filled at. The difference is your slippage. After 30 days, you'll have a real number, average cents per side. Multiply by your annual trade count and you have your annual slippage bill. Most active traders discover the bill is alarming, and the discovery drives them to switch order types or change which names they trade. You can't manage what you don't measure. Slippage is no exception. So slippage is the silent edge killer. 5 cents per trade times 500 trades is real money, often equal to or larger than the strategy's annual edge. Use limit orders in liquid stocks where spreads are tight, and reserve market orders for fast or illiquid conditions where fills must happen. Track intended versus filled to expose the cost. The edge you preserve through execution choices is just as real as the edge you generate through setups. Subscribe for the full method and trade your own plan. Education, not financial advice.